One of the very important investment products available to taxpayers and investors is annuities. There are different types of annuities available out there with different tax implications, and it is important that tax practitioners understand the differences. Probably the simplest annuity out there is a voluntary annuity, which is bought on a fixed term basis. In other words, you buy the annuity for a 5 or 10-year period, and it works like this. You give the financial institution a lump sum, and they then pay you a regular income for a certain period until the lump sum and the interest is paid off. It works like a loan in reverse. You give the institution a lump sum and they pay it back to you over a certain term or period. The repayment amount is a fixed amount for the term of the annuity. Part of the repayment amount is repayment of capital, and part of the repayment is called interest, although it's not really interest and does not qualify for the exempt portion of interest earned from a normal bank investment. If you buy an annuity like this with an amount of 100,000 Rand, for example, for a fixed term of 5 years, then the capital portion of 100,000 Rand you give the institution will be paid back to you over 60 months. This repayment of capital will be 100,000 divided by 60 equals 1,667 Rand per month every month, shown on the IT3 as code 3612, and is non-taxable as it is your own money they are paying back to you. Depending on the annuity rate and how the annuity was structured at the time when the annuity was purchased, an additional IT3 code 3611 amount per month will be paid to you, and this would be what is commonly called the interest portion. This code 3611 amount is fully taxable. After the term of the annuity, all the capital and all the interest will have been paid to you and the annuity ceases. Note that these fixed term annuities may be structured to pay monthly or annually in advance or in arrears. When you retire from a pension fund and or when you mature a retirement annuity policy, then you may take 1/3 of your amount in your fund as a lump sum, and the other 2/3 must be used to buy an annuity to give you a monthly pension. The income from this annuity is fully taxable. You do not have to take the 1/3 lump sum. You can decide to convert the entire amount you have in the fund to an annuity to give you even more monthly pension. I want you to think about a case where a taxpayer paid contributions to a retirement fund and the contributions exceeded the legislation limits for the portion of contributions that could be claimed as a deduction when the contributions were made. The portion of contributions that could not be claimed over the years will be recorded by SARS. You are allowed to deduct the sum of these excess amounts from the 1/3 lump sum before the tiered tax tables are applied to determine what tax, if any, is due on the 1/3 lump sum that was taken. That's all well and good, but what about a taxpayer who elects not to take 1/3 as a lump sum and prefers to convert their entire amount in the pension or RA fund to an annuity? Do they then lose out if they have accumulated excess of contributions they could not claim as a deduction when the contributions were originally made? In cases like this, the brought forward contribution amounts not claimed in the past will be paid out as non-taxable annuity income. If, for example, you accumulated 80,000 Rand contributions in excess of the limits you were allowed to claim when the contributions were made, then that 80,000 will be paid out to you as non-taxable annuity income. For example, if you get 10,000 Rand a month or 120,000 per year income from your annuity, then the IT3 should show taxable annual annuity income of 40,000 Rand and non-taxable annual annuity income of 80,000 Rand. These rules fall under Section 10C of the Act. In the case of a taxpayer with several lump sums and several annuities, then the non-taxable portion is accumulative between lump sums and annuities and applied on a first-come, first-served basis. The 2/3 portion of the pension or RA value is often placed into a living annuity, which is so called because although there are no guarantees, it is supposed to provide an income virtually for life. The income may not be all that great for the entire period if income requirements are extravagant or if growth rates are poor, but it is supposed to always provide some income in theory. Let me explain. The living annuity allows a maximum of 17.5% of capital to be paid out as income, and this helps prevent the capital being depleted too rapidly. Maybe the best way to explain the cash flow would be by using a living annuity calculator. The annuity example video lecture explains this.